You know, there's a very specific kind of sinking feeling you get when a stock that's supposed to be boring suddenly starts acting like a meme coin.
Oh, yeah.
It's not excitement. It's usually nausea.
Especially when that boring stock is, a cornerstone of so many institutional portfolios.
Right.
You expect that volatility from some crypto play, not from the company that tells CIOs which software to buy.
Exactly. Welcome back to Talk Tickers. Today we are dissecting the absolute train wreck that was Gartner's Q4 2025 earnings call, ticker symbol IT. If you were watching the tape on February 3rd, you saw a steady Eddy compounder lose nearly a third of its value in one session.
It was a full-blown capitulation. We're talking a drop from, a close of $202.40 down into the 150s.
It was brutal.
And frankly, it's the kind of move that forces you to question your entire thesis on a sector. We're recording this on February 8th, 2026, so the dust has settled a little bit, but the confusion hasn't.
That's the mission for this deep dive, then. We need to figure out how a company that technically beat its earnings estimates managed to trigger a 30% sell-off.
Right.
Is the market just overreacting, or is the Gartner business model fundamentally broken?
That is the billion-dollar question. And the answer seems to involve a very specific government acronym that's causing a lot of headaches.
Okay, we will get to the DOGE factor because that is the wild card here. But let's start with the crime scene photos, the headline numbers.
The rearview mirror.
Yeah. I mean, if I just look at the print, Gartner reported adjusted EPS of $3.94. The street was looking for $3.51.
That is a massive beat. 43 cents.
A huge beat.
All right. And if you stopped reading there, you would have bought the stock. You'd think, okay, the machine is humming along just fine.
And revenue, $1.8 billion, which was, basically flat. Technically a 0.5% miss, but that's a rounding error.
Essentially in line. So profitability is up. And look at the shareholder yield stuff, which is usually what keeps those institutional investors happy.
Oh, they were aggressive. They bought back $2 billion of their own stock in 2025.
$2 billion.
They knocked down the share count by about 8%, down to roughly 71 million shares. Free cash flow was strong, $1.2 billion. Operationally, looking backward, the machine was working.
Exactly. On paper, this looks like a solid carry-on quarter. But, markets price the windshield, not the rear-view mirror.
And when investors looked through that windshield, they saw a brick wall.
A brick wall, yes.
Let's unpack that brick wall. It comes down to two words: guidance reset. This is where it all broke.
That's the polite term for it. I think the market called it structural margin compression.
Right. So management guided 2026 revenue to be at least $6.455 billion.
Which on an FX neutral basis is only 2% growth.
2%.
Correct. For a growth compounder that trades at Gartner's multiple, 2% is effectively zero. I mean, you're stalling out.
And if you aren't growing that top line, the valuation premium just evaporates. But that wasn't even the worst part, was it?
No, the revenue stall was bad. The EBITDA guide was the killer. They set a floor of $1.515 billion.
Okay, help us contextualize that number. What does that do to the margins?
It implies a margin baseline of roughly 23.5%.
Then in 2025, they were running at
nearly 24.8%.
Yeah.
So you're seeing a huge structural step down in profitability, over 100 basis points of margin just gone.
And usually when margins compress, it's because a company is investing heavily to drive massive growth.
Right.
You know the pitch. We're spending now to grow 20% later. But here they're telling us margins are dropping and growth is also dropping to 2%.
That's the disconnect. That's what broke the whole thesis. Management called it a new baseline to allow for reinvestment. But what the market heard was, our business is more expensive to run and it's harder to get new customers.
That just destroys the unit economics story.
It does. You have to spend more money just to grow less. Your flywheel is broken.
It feels like that classic transition year trap. Investors hate those because they're basically a request for blind faith.
And the visibility into 2027 is non-existent because of the macro environment. This is where the call got really dark.
Yeah. CEO Gene Hall dropped a quote that I think is going to haunt the whole tech sector. He said customers are slowing and deferring everything possible.
Deferring everything possible. That's not just we're being careful.
No, that sounds like a capital strike.
It is. He talked about tougher selling environments, more scrutiny, elevated deal approval. It means the CIO can't just sign the check anymore.
It has to go to the CFO now.
Or maybe even the CEO. Every dollar is being fought over.
But what was interesting was the specific reason they gave. They didn't just blame the economy. They pointed fingers.
And this is where it gets geopolitical. They specifically cited the DOGE impact.
The Department of Government Efficiency.
Yes. an explicit mention of these DOGE initiatives hitting their U.S. federal clients.
For listeners who maybe haven't been tracking this, this is the new big push to slash federal spending. And usually, government contracts are the safety net for tech stocks. They're the boring, reliable revenue. But Gartner is saying that safety net has holes in it.
Massive holes. And here's the nuance that really matters. Gartner's federal contracts are mostly one-year terms.
So they're just renewable subscriptions.
Exactly. So if an agency director gets a memo on Tuesday saying, cut non-essential spending by 15% immediately, Gartner's renewal on Wednesday is the easiest thing in the world to cut.
Just don't renew. No penalty.
No penalty. And the data backs it up. The U.S. federal contract value, which is their leading indicator for that whole sector, was basically flat. It's dead weight.
And it's not just the public sector, right? They mentioned trade policy, too.
Evolving trade policies was the phrase. That's code for tariffs and supply chain anxiety. So you have this pincer movement. Government clients are scared of the axe. Corporate clients are scared of trade wars.
And when you're scared, you don't buy strategy consulting. You sit on your cash.
You sit on your cash.
Which brings us to Gartner's countermove. I mean, they aren't just taking this lying down. A huge chunk of the call was dedicated to this transformation of their insights business.
It was very spirited defense. They laid out 4 pillars for this overhaul: impact, volume, timeliness, and user experience.
Timeliness really stood out to me. Gartner has always had this reputation for being slow, right?
Oh, absolutely. The librarian of the internet.
By the time they publish a report on a trend, the trend is half over.
They're trying to kill that image. They claim they've cut the creation time for high-value assets like the Magic Quadrant by 75% compared to 2024.
75%, that's a massive operational shift.
It's huge. They also introduced first-take content, so same-day analysis. If there's a security breach, Gartner wants a briefing in your inbox that afternoon.
That moves them from academic research to news and intelligence, a different value prop.
It makes them stickier. And then, of course, there was the AI angle. You can't have an earnings call now without talking about your neural network.
But this actually sounded kind of practical. They're using it to decide what to write about.
Right. The AI model predicts what clients will want to read, and they assign analysts to it. They claim the Active Insights library grew by 50% because of this.
And the engagement numbers were staggering. 6,000 AI documents, over 1,000 use cases, 500,000 AskGartner questions answered last year.
And that AskGartner tool is the key here. It's their proprietary LLM. Think of it like ChatGPT, but trained only on their data.
So it doesn't hallucinate.
That's the promise. And the thesis management is pushing is simple. Higher engagement equals higher retention.
If I'm using the tool every day, I'm not going to cut the budget.
That's the theory. But here's the skepticism from the street. Is this actually new value, or is this just table stakes now?
Right. If your search tool doesn't work like ChatGPT in 2026, your product is just broken.
So are they innovating, or are they just frantically catching up? And more importantly, does engagement pay the bills? If your budget is frozen by DOGE, you still can't sign the renewal check.
Exactly. Engagement is a leading indicator. Revenue is the lagging one.
And it hasn't shown up in the P&L yet. So until it does, the market sees these transformations as costs, not revenue drivers.
Yeah.
Hence the margin hit.
Speaking of costs and capital, let's look at the balance sheet, because they're making some very aggressive moves there. They announced they're selling the digital markets business.
Yeah, this is a cleanup. Digital markets was basically a lead gen business, Capterra and those sites. It's a different model.
So they want to be a pure play subscription business. Simplifies the story.
It does. But they also issued their first ever investment grade bond. They're leveraging up.
And this is the most important signal, I think. They have about $1.2 billion left on their buyback authorization. By issuing debt now, after the stock has crashed 30%, they're basically loading the cannon.
It's the soft floor theory. It's management saying, we think the market is dead wrong, and we're going to use the bank's money to prove it.
They're going to buy their own dip.
Which puts a persistent buyer in the market, the company itself. It also tells you they don't see any big M&A deals out there. They think their own stock is the best deal on the board.
Which is comforting, but it also confirms organic growth is tough right now.
It's what you do when you're a mature cash cow, not a rocket ship.
Let's zoom out to the sector for a minute. Gartner is often seen as a proxy for the whole tech ecosystem.
Right.
And if you look at a chart, Gartner is down almost 70% over the last year. Meanwhile, the XLK, the tech benchmark, is up.
It's an ugly divergence. And there's a specific number in the Q4 report that explains why. consulting revenue?
It was down year over year, $134 million versus $153 million.
That's the canary in the coal mine. Your subscription is the utility bill. You have to pay it. But consulting, that's discretionary.
You hire consultants for new projects.
Exactly. When consulting revenue drops, it means companies aren't starting new things. They're hunkering down.
So Gartner's basically telling us that the AI boom might be stuck in the talking phase, not the spending phase.
Or the spending is very, very narrow. Companies are buying NVIDIA chips. They're buying Microsoft Copilot. They aren't paying Gartner $500,000 for a 5-year strategy. Not right now.
Which makes the 2026 guidance even scarier. Management says contract value will accelerate throughout the year.
The dreaded second half weighted guidance, we call that the visibility trap.
Why is it a trap?
Because we're in February. Q1 is a huge renewal season for them. If they miss in Q1 because of these DOGE cuts, the hole just gets too deep. You can't make it up in Q4.
So they're gambling on a macro recovery they can't control?
They are. So the catalysts to watch are pretty specific. One, retention rates in the non-federal sectors. If the corporate side cracks, the stock goes lower.
And number two,
the success of AskGartner. We need to see evidence that the AI tool is actually driving upsells. We need to hear them say, clients who use this tool increase their spend by 10%.
Engagement is vanity, sales are sanity.
Exactly. And right now, the market is questioning their sanity.
Okay, we've covered the crash, the guidance disaster, the DOGE headwinds. Now let's get to the part everyone waits for. This is not financial advice segment.
Standard disclaimer. We are just two voices in your headphones. Do your own diligence. This is purely hypothetical.
But if we were pitching a trade based on this call, what's the play? I'm calling this one the bureaucracy straddle, or maybe the DOGE proof pair trade.
I like it. Walk me through the setup.
Okay, the setup is simple. Gartner is being punished for U.S. federal exposure and margin compression. The stock got crushed.
But they have a massive buyback cannon loaded $1.2 billion and a solid balance sheet. They're not going bankrupt.
Not at all. So, leg one of the trade. You sell aggressive out-of-the-money puts on Gartner.
Interesting. So you're shorting the fear.
The implied volatility is sky high. The premiums are fat. You're betting that the $1.2 billion buyback acts as a plunge protection team. You're daring it to drop another 20% while the company's buying every day.
You're harvesting the panic premium. But that's risky. What if deferring everything becomes canceling everything?
That's where leg two comes in, the hedge. You go long a basket of AI implementation pure plays that don't rely on government contracts.
Okay, walk me through the logic there.
Look at Gartner's own data. They had 200,000 client conversations on AI. The demand is real. Corporates are desperate for help.
They're just not buying it from Gartner right now.
They're buying the implementation, the companies that actually write the code and build the pipes. You use Gartner's research to confirm the demand, but you buy the stocks that actually capture that demand.
While you use Gartner's buyback to cap your downside on their stock, it's a bureaucracy straddle.
Exactly. You bet on the government cutting costs, which is capped by the buybacks, and on corporate spending on AI implementation.
It's wild, but it's clever. Okay, bringing it back to reality to wrap this up. Gartner's in a tough spot.
Yeah.
They delivered a Q4 beat, but they handed us a 2026 reality check. They're betting the farm that better content will fix slow demand.
And the market has priced in a broken growth story. Management says it's a cyclical pause. The truth is going to be in the renewal rates over the next 2 quarters.
If those numbers slip further, that 23.5% margin baseline is going to look like a ceiling, not a floor.
And that's why we watch the tape. Thanks for listening to this deep dive on Talk Tickers. Keep your eyes on those renewal numbers, do your own diligence, and we'll see you next quarter.
See you then.